Welcome to the Commonfund Point of View. I'm Julia Moore, Chief Investment Officer of Commonfund OCIO. In this podcast, we look to give you our latest views on capital markets and investing in 15 minutes or less. Today, I'm very pleased to be joined by Aaron Miller, Managing Director and Head of Venture Capital for CF Private Equity. Aaron, let's start with the current outlook for venture capital. Many of our clients are asking, are the strong returns of the past decade behind us?
I think it's a good question. It's important when you're evaluating venture to know that today's returns were seeds planted 10 years ago. So in this example, a fully harvesting fund should be distributed is a 2015 vintage. So timing the market is nearly futile. When transformation changes occur in venture, this leads to incredible opportunities. And we've seen that play out in our returns over the last 40 years. And we think that this platform shift from AI by most, if not all accounts, will be larger than the internet, mobile, and cloud. So I'm very excited about the future returns of this asset class, but it's an important question. It does depend. Depends on your access, the selection, the vintage, the strategies, and returns are skewed by home runs or power law companies. So we've run the analysis. The top 1% of exits deliver over 30% of total industry returns. So you must be in that top quartile to generate that outperformance. And we see manager dispersion. It's the most defining feature of venture capital. So if you can access those managers, you can be compensated well, but for everyone else, it can be unfavorable. We've seen outperformance during historical platform shifts, the early bets in the personal computer PC era, networking, internet, mobile, cloud. We were all rewarded. So we think that will be the same case here in the AI market. And so when you look at what we've seen just in the early days, 3 years into this AI revolution, if you will, we estimate aggregate run rate revenue for venture-backed AI startups is in excess of 25 billion, a figure that's growing rapidly and a scale unprecedented. So we are excited about the returns going forward, and obviously we'll continue to capitalize where we see platform shifts and the ability to invest in these companies.
Great. Another topic that often comes up is on liquidity. How has liquidity in the venture capital asset class evolved?
Yeah. Well, venture liquidity is like a faucet. It turns off and it turns on. 2020 through 21, we saw significant liquidity boom. We distributed over $2 billion back to our limited partners, well above the historical average. But from 2022 to 2024, we saw a lack of new liquidity events. So it did freeze. That was caused by interest rates rising, valuation reset, the public market demand for IPOs, the U.S. government push to discourage M&A, which has always been an exit window for venture-backed companies. But however, even those halted IPO markets, we still return capital because we had exposure to companies from the prior years and they were sold down in an orderly way. But the liquidity window today has opened. We see structural changes that enable more liquidity as well. There's pent-up M&A demand. The IPO demand is on the rise. We've seen the rise of the secondary markets and continuation funds. But we understand that these structural changes are underway. And there is a dearth or a lack of high growth stocks in the public markets. Investors are seeking growth as evidenced by the stock prices of a handful of massive hyperscalers, the Mag 7, which now represent 35% of the S&P 500. So we think today the private markets capture that innovation, that scaling growth type companies, leaving public markets holding those that are hyperscaled institutions that dominate the public returns. So companies are staying private longer, and that value creation happens in these private markets. And so the upside I think one can get from these high growth companies has shrunk dramatically over the last 30 years. And so, once upon a time in the late 1990s, IPO, you could garner 80%, 90% of that value creation holding the public company. Now, we think 80% of the value is captured in the private markets. And so if you fast forward to today, there's 17 companies worth over 20 billion. 20 years ago, there was less than one company that was $20 billion in value. So clearly valuations are accruing and the value is accruing in the private markets. And if you want growth, I think the best way of doing that is in the private markets.
Erin, you touched on AI a number of times. We all know AI has been a major driver of returns in recent years, both in public and private markets. So the question is, are we in an AI bubble? And where is AI headed next?
Yeah, it's a good question. We see it in the headlines. I think it's too early. It's certainly everyone's talking about it. The NASDAQ is up 30% from the bottom in May. If you look at NVIDIA, it's trading at 40 times PE, but on a forward basis, it's 25 times private PE. That doesn't feel like bubble territory. And we've seen several drawdowns for NVIDIA during the DeepSeek moment, as well as tariff announcements. But I think the fear of AI bubble is understandable. The S&P 500 is obviously up since ChatGPT was released. Investors are worried about the inflated valuations and wondering if there's a correction looming. But I think it's important to distinguish between the big tech, that's the hyperscalers, the Microsofts, the Googles, the Amazons, the Metas of the world, and little tech. And little tech is the venture-backed startups building with or on top of the AI. So much of the capital invested in AI infrastructure is coming from big tech, the public companies. And these companies are spending 50 to 60% of their free cash flow on investments into AI. So they're foregoing dividends and stock buybacks. So it's a calculated and reinvestment strategy by these of some of the most profitable companies in history. The top 10 companies in IT generate over $1 trillion in free cash flow in aggregate. So the competition to build out AI infrastructure, the data centers, the GPUs, the proprietary models is fierce. These firms believe that they want to be the supplier of compute, and core AI platforms should yield to dominant market positions. But this is an arms race that I think it will lead to falling compute costs, which is a net positive for the little tech companies. Leading tech CEOs agree we don't have enough compute power in the short term, medium term. And we haven't even moved to the next phase of AI, which is agentic or reasoning models, which will be even more significant. So we do believe this phase shift and transformation is as big as the internet. And we're only 2.5, 3 years into the super cycle. And these cycles usually take 10 plus years to play out. But we estimate there's real growth and underlying scaling of these companies. On an aggregate basis, the aggregate run rate revenue for these venture-backed AI companies, the little tech, is over 25 billion. And that figure is rapidly growing. And even if it's today's infrastructure build-out proves too optimistic, we think startups are likely to benefit from this oversupply. In other words, the big tech takes the CapEx risk and the little tech can reap the benefits. But it's important to remember that, without venture, one can miss out on these 20 years of compounding the next Amazon and Google, all of which have benefited from these platform shifts. And so, venture is a barbell of opportunity. You try to make early bets and then continue to compound with more money into the large early winners. And we're seeing some of those come out into play today. So we do think this is a market that should benefit startups. And obviously computing power, it's difficult to predict how much we need, but these are rational bets by hyperscalers and big tech looking to become the computing platforms that enable these startups in the future.
Sticking with AI, will AI become a truly global phenomenon, or will it remain concentrated in the US and China?
Yeah.
Specifically, on that point, how does AI development differ between the two countries?
Yeah, it's a good question. I think it's an important question. I do believe, and most practitioners believe, AI will be global. Frontier development remains concentrated. The next wave of impact will come from AI and how it's deployed and regulated, not just who trains the biggest large language models. But if you look at the numbers, the US is leading by a large margin in terms of the dollars or capital invested. And we've seen some of these early breakout companies. But if you look at from a talent, a research, or a publication basis, I've seen it shown both ways, where US and China are neck and neck. But Clearly, US wants to be the dominant leader in AI, and you need to factor in the size of our enterprise market. So much different than other markets, we have a very robust business-to-business marketplace. China, on the other hand, is leading in hard tech. Think of robotics and automation, and AI can really accelerate that technology deployment. And the current governmental perspective in the U.S. wants us to lead in AI transformation, and we're still in the early stages. But I would note that as this market matures, you'll find regional nations or trading blocks that will seek sovereign alternatives. They may not want to be totally beholden to a US or a China technology backbone. So you'll see some bifurcation. But we're already seeing sovereign nations looking to have an advantage or have their own market winners in their localities. And so we see that in the Modi government in India. They want homegrown leaders. The Middle East has been very strategic about the build out to ensure they're not left behind on this economic transformation. So I do believe it will be global, but the early stages show that U.S. is leading on that front.
Last but not least, what other investment themes is Commonfund currently exploring?
Yeah, a lot. It's not just AI, but it's important to realize that AI is going to be fundamental to technology going forward. So AI is not just semiconductors, GPUs, or data centers, or large language model. I think from this point forward, all verticals and sectors will need AI as part of their business and deployment. And so we're moving into that next phase of AI where applications will be deployed. And we're seeing those companies scale from a revenue standpoint, from customer care, code generation, healthcare, and many other segments. And so we're in the beginning stages, I would say, for this innovation, but we're going to see it proliferate into aerospace, defense tech, cybersecurity, public safety, robotics, supply chain, logistics, transportation, new energy sources, manufacturing, drug discovery. And I think there'll be embedded AI within all of that. And so, tech is no longer a product, I would say, or a cost center. It's something that's being applied to most, if not all, industries. And so the market opportunity is moving not just from a product, but to a service. And the services part of that US economy is 5 times larger than the digital economy. So I think you'll see AI embedded into all these verticals, and they'll be targeting different sectors and different markets, but they'll be using the fundamental technology to enable their growth.
Thank you, Aaron, for your thoughtful insights into the current landscape for venture capital. At Commonfund, we believe that allocations to private equity and venture capital will continue to generate long-term returns relative to public markets and represent a compelling opportunity to capitalize on a perpetual time horizon to compound value over time. Specific client allocations will be a function of each client's return objective, risk profile, and illiquidity budget. Well, this wraps up our Point of View podcast. Please join us in January for our next episode of Point of View. Thank you.
Thank you.